First, I want to thank Amelia for a great presentation and good follow-up. I think it was a really good structure after my really smushy talk about mindsets. So thank you for that. I'm really excited to do this. I was asked to moderate. And this is, I'm moderating in a session of where we probably get most of our questions, which is, how does money move? Where do we get money from? And we have, as mentioned, Angela Smith is here, Utah Innovation Fund, and Dustin Cook is here from Intermountain Ventures, and Craig Jeppson from Epic Ventures. And so Angela and Dustin, I have not met you both before, but I work with Epic a little bit, and Jack. So this will be great. So what I'd love to do is just start off, Angela, you could start, and just a kind of a 60-second overview of just the fund and the types of investments that you look at, or anything that you feel would be important to say.
Yeah, first off, thank you all for being here. It's great to see this so well attended. I'm with the Utah Innovation Fund, which is a $40 million fund created by the state of Utah. And the reason this fund was created is because we understood that there is a gap in the Utah ecosystem when it comes to funding. And where that gap is in deep tech. A lot of venture funding in Utah is very focused on SaaS, very focused on marketplaces, even tech-enabled consumer. And that's kind of the world I come from. Previous to this, I was at a traditional venture fund investing in those areas. And there's a reason that most VCs tend to gravitate towards those. And I think we'll get into why there isn't a ton of funding for deep tech in Utah. But the state of Utah wants to see more development in these sectors. And so we created this fund where pre-seed fund will do the first equity investment specifically for companies rolling out of universities. So we know there's a lot of technology research happening on our campuses. We're not seeing enough of that make it into industry. And so that's the reason our fund was spun up. Now, that being said, we're not a grant program. We're not free money. We are only investing in venture-backable companies. We need to make a return for the state. Otherwise, the state's going to be like, oh, this isn't a good idea, and cut our funding. A lot of people get confused, like, oh, why aren't you investing in everything coming out of the universities? And we still have to have venture returns, which we'll also go into, I think, in this panel, what that means and what that looks like. But we are here to be a resource, and even if you're not a venture fundable company, we have a lot of resources to help you get funding and help you get education and training and things like that. And we invest $250K check size typically. Great,
thank you.
Great. Pleasure to be with you this afternoon. So Dustin Cook, I'm with Intermountain Ventures, which is Intermountain Health's venture capital arm. So Intermountain Health, if you're not familiar, is a health system in the Intermountain West, Utah, Colorado, Wyoming, Montana, Arizona, Nevada. I think I got all the states in there. But we're really focused on investing behind Intermountain's mission, which is helping people live the healthiest lives possible. We really focus on companies that either simplify care, whether that's simplifying how patients can get care, simplifying how physicians can actually deliver care. We know that physician burnout is a huge problem. And we also focus a lot on investing in proactive care. How do we actually help people stay healthier longer? How do we help them avoid needing really expensive and really costly treatments downstream when they can be avoided upstream? We were created in 2019 as one of the founding partners there, and we're an evergreen structure, so we continue to receive capital and continue to invest. We typically invest in about 4 or 5 companies every year.
Awesome. Thanks. Just want to echo what they said, Angela and Dustin said as well. Just thanks for having us here. Fun opportunity to be able to talk the venture landscape and share some of our insights. So I'm Craig Jeppson. I'm with Epic Ventures. We actually are office not far from here, just up here in Research Park, so a short commute for me this morning, which was nice. But yeah, Epic was founded in the mid to late 90s, so been around for a good while. We actually just closed on Fund 7, a little north of $200 million. We primarily focus on seed and Series A businesses, and we generally will, with this most recent fund, will write anywhere from, and these are rough numbers, anywhere from $1 to $5 million initial check size with reserve capital for follow-on investment as well. We like to lead rounds, but we also are like to be friendly. We don't have sharp elbows, and so we are happy, depending on the opportunity, to play friendly syndicate as well. In terms of industry and verticals that we look at, we like to say we're tech generalists. If you take a look at our portfolio, we have a decent amount of fintech, B2B SaaS that Angelo spoke to previously, as well as we do a good amount of volume as well in biotech and health tech. Life sciences. So that isn't by any means the broader scope of our portfolio. We like I said, are generally tech generalists, and so if you look at a portfolio, you'll see a smattering of other verticals as well. But those are our kind of our core competencies.
Great, thank you to the three of you. So after this question comes up and we learn about spaces, another one of in the Doman studio, the questions we get are, what we try to start to do is an alignment and start to figure out how companies can make themselves viewable to you. So the question I have is, given the current funding environment, how would you describe what a venture-backable company looks like? And this audience is pretty spread out. We have a lot of researchers, but we also have community from Utah working on Weird Games earlier and other ventures here. So if we want to go in the same order, that'd be
Sure,
great.
happy. That's a great question. What does a venture-backable company look like? And I get that question a lot. And I think to understand that, we kind of need to step back. A lot of you probably understand how venture capital works. But as I've interacted with a lot of founders, especially ones coming out of universities, I realize there's kind of this gap of understanding how our model of venture capital works. And so if you understand that, then you understand why we're looking for the types of companies we do. So traditional venture funds, just to level set, sorry if this is super basic, but traditional venture funds have to go out and raise their own fund. So a lot of what VCs are doing is raising money, a big portion of that time. I'm lucky because we just went to the state and the state gave us money. But most traditional funds, that's the majority of what they do. It's not their own money that they are giving out, which may seem basic, but I actually have invested in a founder and he's like, oh, that wasn't your $10 million? I'm like, I wish I had $10 million, but I don't. So there's a responsibility of VCs. They are taking someone else's money. And typically, it's from very, very wealthy people. And so a lot of people are like, oh, that person's a billionaire. Who cares if you give us $1 million of their money? But what people don't realize a lot of the time is that other, what we call LPs, people who invest into venture funds, a lot of times are pensions. So there's a responsibility to teachers, there's a responsibility to firefighters, to policemen, that we get them a good return. And so we as VCs, we're middlemen. That's what we are. And so we have to take money, other people's money, invest it, and then provide a return to them. And if we don't provide a return, we're out of a job. No one's going to give us more money. And so the types of companies we're looking for are really actually pretty unique. Venture capital is not a model for most companies. We're expecting typically what we call a 3x return, and we need companies to what's called return the fund. So if a fund is $100 million, we expect to get $100 million when that company is sold. That's the goal. Not if you're a founder and you sell for $20 million, you sell for $50 million, that's life-changing for you. That's not going to really move the needle when we have to give our investors back $100 million, plus the expectation that we return at least 3x to be a solid venture fund. And so we really need companies that are billion-dollar-plus outcomes. That's the type of company we're looking for. So there's two main things we look for in a venture-backable company. We look for a founder who's not going to take the easy way out, isn't going to take the $10 million exit or the $50 million exit, but is really in it for the long run and wants to get to that unicorn status. And then we look for companies in really, really big industries. And that's not the majority of companies, and that's okay. There's other options, there's other funding routes for most companies. But if you're targeting, hey, I'm in this for the long run, I want generational wealth for my family, I want to solve a huge problem and I'm going into a huge market, that's what I say is a venture-backable company. And that's because of the math behind how a VC fund works.
That's a great framing. Thank you.
Yeah, I mean, you said a lot there, Angela. Maybe just adding to that, we look at about 600 companies every year, and we do some level of diligence on about 60 of those, and then we make about 4 or 5 investments. So it's kind of that 100 companies you look at initially to get to the one. And maybe to the question, how do we go from 600 to maybe that first 60 that actually make our diligence is some of the things that Angela mentioned. Is number one, what's the market size? Is this actually a big enough space and a big enough problem to return the power law? Because all venture capitalists are looking for those investments that are going to be 10xers that can return their funds. So is the market big enough? Number two, around founders. Why this founder? Are they a repeat entrepreneur? Have they had success? Or do they have some experience in what they're talking about that gives them the level of insight we think is important enough? Is another thing that we look at. And then third is finally the idea. And from the idea, is there something there that we find unique, intriguing, something defensible? And it's usually those three questions that help us get from, is this one of those 600 down to that 60?
Great.
Yeah, those are all solid points. And I think a lot of the people here understand that startups are incredibly risky, right? I think a comment was made about second mortgages in the previous panel, and that's highly risky, right? So from the founder's perspective, they're going into this high risk environment, and from the VC side, we are investing in this high risk environment. And Angela made the point of, we have limited partners that we need to return capital to. So when we look at what a venture backable business is, I think it's a lot of the points that they've hit on already of high risk, high reward, right? We are entering into a partnership with you from a capital perspective and a strategy perspective that is high risk, but you've convinced us and we are bought in on the idea and the approach, and we because of that we expect high reward, high risk, high reward. And to Angela's point of that threshold of needing to return the fund, that is absolutely one of the foundational criteria that we consider with every single deal that we look at. If we invest, we have been bought in and we are fully convinced that this particular investment is capable of returning our fund. So if we have a $200 million fund and theoretically invest $10 million, we fully believe that this company is capable of 20xing over that 3 to 5 year time span, hopefully. That being said as well, being a huge proponent of capitalism, there are so many ways to make money, and because of that, there are a lot of opportunities for great lifestyle businesses. And Angela, I think hit on this as well really well. Is there's a lot of opportunity to found businesses that may return a great life for the people involved, for the founder and others who are early in that business, and may be very profitable and do wonderfully for them, but it may not really move the needle for a venture capital firm. So what we're looking for is the industry-defining innovation, right? The products and the innovation taking place within each of these businesses that we're looking at truly needs to be industry-defining and disruptive, and not just incremental improvement on the status quo.
All right, the next question is a little bit tricky, but I think it's going to serve the room well because it could have been asked one way 6 months ago, and it's going to be asked another way today. I know just in the past 2 weeks, I've had really interesting conversations here at the university, and a lot of you already know the kind of early stage funding models that happen at universities is usually in grant form, and that has really shifted radically. So we're now looking at new models and looking at private equity and VC and trying to figure out ways to deploy capital across the university. So my question to the three of you is, it would have been one way to answer it because of COVID and other things. How has the landscape changed in the last 5 years? But I think it's changed again, and I'm curious what the outlook looks like, what advice you have, what you're seeing, how that could serve useful to the room. Is that too deep or it's a big one?
No, I can kick us off. I think, you look at COVID in like 2020, 2021, the beginning of this past 5 years, it was really all about growth, and you had investors who were paying for growth. It didn't matter how financially, from a profitability standpoint, what the company is doing. If the company was growing, that's really all that mattered. And, saw really, really high valuations in companies. And, 2023, 2024 have been really tough years for many of those companies. We've seen a lot of kind of bridge rounds, down rounds, things like that, because there's been this pivot now to profitability and a real focus on not just companies, what's your growth rate, but, what does your actual margin look like and how close are you to profitability and are you profitable? So I'd say there's been a lot more focus on companies driving profitability now in 2024 and 2025 than we saw in the early 2020s. And I think looking at the market in 2024, somewhat of a greater acceleration in opportunities and deals we were seeing. I think that's somewhat been tempered just by the uncertainty that has racked public markets in 2025 with tariffs and things like that. We've seen the S&P go up and down.
Across the board, too, I think, not just industry specific.
Right. It just adds to the level of volatility. And so it seems like there are a lot more investors right now who are maybe not investing at the same level they were in mid to end of 2024. But we've got two others on the stage. Love to hear their thoughts.
Yeah, I'll try and draw a connection to something that I imagine most people here are familiar with, and something that I just recently went through. So, a few years ago, during the time period that you referenced, I bought a house in Texas, and at that point, it was very much a seller's market. Right, there were literally every house that you look at, there are literally dozens of offers on every house. All of them over asking, all of them cash offers, waiving inspection, crazy terms, like you name it. It was absolutely a seller's market. Fast forward to a couple of weeks ago, I just sold that house in Texas, and the market dynamics had flipped. Very much a buyer's market. Thankfully, I made out okay, and everything's good. But it was just a completely different experience. The time to close was much more standard. Previously it was people were saying we can close in 2 weeks. We can just crazy terms. Valuations. Dustin talked about those have come back down to historical norms. It's just the dynamics have shifted, and I think in the same vein, from the VC perspective, there's a similar story to be had there. There's a lot of a few years ago, capital was abundant, valuations were high, and deals were moving very quickly. I think a lot of those metrics have now normalized to an extent, right? So I think that we'll likely see that going. The focus has gone to business fundamentals and talking about profitability of are you profitable, or do you have a clear path to profitability, and can you explain that, rather than the growth at all costs approach to VC funding.
Yeah, we've noticed that shift too, and thanks for that, Angela.
Yeah, I mean, if you ask any VC, you're going to get a slightly different opinion, and it's from where they're sitting at their fund, from the amount of money or where they're at in their fund stage. But I do agree with what they're saying, that things are a little bit hesitant right now. It's not that there's money out there, it's that the public markets are super volatile right now. They're going up, they're going down, and there's not really been, over the past few years, a great IPO market. We haven't seen a ton of companies IPOing. And if companies aren't IPOing, then venture investors aren't getting their exits, and we aren't able to return money back to our LPs. And if we're not returning money back to our LPs, they're not giving us more money to invest. And so that's kind of the why behind why things are a little bit hesitant. I will still say there are plenty of funds that have money, and especially the further away you get from an IPO. So if you're going out for pre-seed funding, there's still money available. But you're going to see it's definitely more of an investor market right now. Investors can set the terms. Investors have more of the options. That was a great analogy about how the housing market works. When I joined the venture capital industry 5 years ago, it was very much an entrepreneur market where we were all competing as investors to get into the best companies. And now we can take our time. It's probably going to take a little bit longer through the diligence process, and so that's what we mean when we say investor-friendly market. But things change all the time, and who knows what's going to happen in the next year. I will still say there's definitely money at the early stages of funding.
Just to add, I think it's a really important point that Angela made, is it's not just the volatility in the public markets, but it's that volatility combined with the lack of exits that we've seen over the last 3 years. Because many institutions who are our LPs invest in venture funds because it's uncorrelated from the public markets, meaning when public markets are up or down, venture provides an uncorrelated bet on that. But it's this fact that since 2021, early 2022, there have been very few IPOs and very few exit opportunities for ventures. So it's really the combination of those two. It's a good point.
Could we flip into something then real quick, just because I think that response is important. Everyone's probably really curious now. How does preparation from the company side when they present to you change now that this is the market and this is what we're dealing with? What are you looking at differently than you were? You talked more about stability and profitability. What else should they know about how they should present themselves or even prepare themselves for build?
Yeah, I think the previous discussion that was had was awesome. I think everything boils down. I mean, honestly, any deal that you look at in any business can really be boiled down to a handful of key drivers for that opportunity. And so there's underlying fundamentals that will drive that opportunity. And I think it's absolutely important that when you get in front of a capital provider, VC or otherwise, that you know those fundamentals of your business. You can speak to lifetime value and customer acquisition costs and margins, and have top of mind, ready to go those answers, and show that I think that you know your business inside and out. So I think those are the key fundamentals, and other metrics like those that are more heavily scrutinized. And we take a little bit more time in diligence at this point, and there's as was said, there's definitely capital available. It is just an investor's market at this point. So diligence time is generally speaking a little bit longer, and we have an opportunity to more heavily scrutinize and dig deeper into some of those finer points.
Great. I'd love to hear, and even on the diligence piece too.
Yeah, I mean, I don't have a ton to add to that. Essentially, just plan on it taking longer. When we say longer, like 1 to 2 months was pretty typical in what we'd call an entrepreneur market. Now it's probably 3 up to 5, maybe 6 months that diligence might take. So just be aware of that when you're thinking about this is the amount of money I need and when I need it and when I need to go out to raise. No, it could take up to 6 months to raise funds. And then I will say, in previous times, it was all growth. Just show us your growth. And if you're growing like 10% month over month, if you're growing 100% year over year, like you're getting investment. And now it's like we're really going to dive into the unit economics. And if you don't have those because you're pre-seed, we need to understand that you have a plan and you understand what your unit economics are going to be and what you're targeting when you go out to market. And so those are just the things that matter. Like profitability is much more where investors' minds are at.
Yeah, and maybe just to finish off the points that have been made, it's really hasn't changed kind of from our diligence point what we ask, but I think the order has changed, right? Because we've always asked all these questions, but like Angela was saying, it was really when cash was flush and people could raise very easily, and there's a lot of investors out there, it was more focusing on, tell me about your growth, how are you going to get customers, where you see partnerships and things like that coming from. And now, earlier in the conversation where funding is tight and there's a lot more focus of just explain to me how you're going to get from where you are valued today to that 2x step up we need to see in 12 months so that we know that you can actually raise cash in an up round. And I think that's where the focus really starts, rather than starting on the growth side. Still important, and we still ask all those questions, but with the way that we prioritize those in looking at companies and evaluating those companies has changed.
Yeah, I would even offer back to the room, these comments are really important. A lot of the conversation we get in our room still comes from the .com era, where just money was being thrown at ideas, and we're way past that now. Funds have matured. People want more diligence in the work that they do. So I'm going to open the room to questions in 1 minute. I have one more question before we do that, because I know there's probably some really good questions coming in, and it's a little bit indirect, but I feel like your perspective would work. When conditions aren't met, do you see interesting non-traditional ways of raising money? What advice do you have so where would someone go if they're not quite there yet? And what have you seen come into the room that's already established when they join up with you? Does that make sense a little bit? I know capital kind of changes once it goes below seed funding.
Corey, do you mean like they're still too early, or maybe they're just not a venture-sized company?
Right. Where would they place risk, and how would they get money if they can't get money from you? How about that?
Yeah.
A little easier.
Yeah, no, it's a good question. And we're kind of a Series A and beyond shop. So there's obviously a lot of friends and family, pre-seed rounds, seed rounds that occur before that. And so as you're raising capital, you know, when we're not ready to invest, it's usually just a stage thing. And so finding those angel investors or those pre-seed shops is a key there. Also, depending on the type of business that you're doing, we're also seeing people getting grants from foundations, things like that, especially in the healthcare industry, where there are actually individual family offices or passionate investors around certain conditions. You know, we're investors in a neurology company that's really focusing on MS, and some of the family and friends, or some of the individual investors, angel investors, are those who have family members with MS or MS themselves. And so I think there's a lot of creative ways you can go after if it's, hey, I'm just still too early to get that first institutional check. There's angels, there's individual investors, there's kind of grants and other opportunities.
Great, thank you. That was great.
I'll add to that, incubators, accelerators, there's organizations out there that will onboard you for a share of equity, usually very minimal, and they provide you with a lot of resources, insight, connections to help you bridge that gap to the point where you become a VC investable business. There's also, I probably fewer and further between, but revenue-based financing as well. There's groups that do that where they'll provide financing to you with the expectation of a percentage of your revenue up to an agreed upon amount into the future. So there's unique ways for sure, creative ways to go about getting capital.
Andrew, you have a pretty unique view of this because you have to look a little bit wider. I'm curious.
Well, I mean, to state the obvious, the best way to get funding is through customers. And so that's just how business works. That's how capitalism works. So a lot of times I have people come to me and be like, I need funding options. If it's not venture capital, which is created for a very, very small percentage of companies, what do I do? And I say, well, go get a customer. Go get someone that's going to pay for what you're putting out there. Now, I know this is kind of a unique room. And when we're talking about really innovative companies, when we're talking about deep tech and companies that take a while to develop their product and true innovation, that's why venture capital exists. That's why these grant programs exist. But my advice is go out and get customers as fast as you can. That's how you want to be funding your business. In the interim, there's the Startup State Initiative. I don't know if you've heard of that, but GoEO, the Governor's Office of Economic Opportunity, they have a nice website called the Startup State, which lists a ton of resources for companies. There's a really great company, female-founded company I know here in Utah called Funded, Fundid, and the founder is really focused on helping companies find alternative ways of financing as well, if venture capital isn't a fit. And then the Utah Innovation Center, which is part of our team, does a lot with grant funding outside of the universities. And so they can help you with that process as well. But the ultimate answer is go out and get customers to fund your company.
All right. And before I open it to the floor, are there any other points you feel like I'm missing or we would want to talk about?
I'll just say there's one question that was sent out to us in advance that we haven't addressed that I think is really important. And it's, as VCs, we have a unique perspective where we work with dozens of companies at a time. And over our careers, literally we see hundreds and thousands of companies go through our pipeline. And I just want to point out the two most common reasons venture companies do not make it. And the first one is they run out of funding. So if you are thinking of going this venture route, you need to be very aware of capital allocation, reaching profitability. That's the number one reason. The second reason is co-founder dynamics. Most of you probably if you're here, don't have a business background, and that's totally okay. We love co-founder teams where one is super technical and understands the whole technical side of the market they're going into, and then one that understands the whole business side. That's really what we're looking for, a yin and a yang in a founding partnerships. But the majority of companies I've been on the board of and I've seen fail are because of co-founder dynamics. And you get further into the business and things get really stressful, and it's the founders falling apart which causes the company to fall apart. So as you're in this stage and you're thinking about really going out and potentially raising money and turning your research, your idea into a company, be really careful about who you choose to bring on as a co-founder. Make sure they have a good balance of the skills that you're lacking. And make sure there's someone that you can be in this with for the next 5, 10, 15 years. It really is very much a marriage. So those are the two things I wanted to point out.
Maybe one last thing I would say, just a piece of advice is don't get discouraged by no. I think raising venture capital is very much like finding your first job. And you're going to get a lot more no's than you are yeses. I mean, I have to say no 595 times a year and yes only 5 times a year. And there's plenty of successful companies that have pitched to us and we've said no to for various reasons that have gone on to be really successful. I think if you look at even the most successful companies who've gone through that venture track, they got a lot more no's than they did before they finally got a yes. So don't let that discourage you if you meet with the first 10 funds and they say no. If they haven't pointed out a fatal flaw, it usually takes a lot of no's to get to that yes.
Yeah, I'll just speak to, I think, the initial touch point with a venture capital or a capital provider in general. I think last year as a team, we looked at over 3,000 businesses, right? And we have the same amount of time that everybody else has in the day. You talked about the funnel of starting really large at companies you're looking at, and you whittle down to doing a small percentage in terms of deals of those businesses, right? So we look at a lot of businesses every single day. I think yesterday I had like 10 meetings throughout the day, and 8 of them were pitches, right? And so the time, I like to think I'm decently smart, but not that smart. So trying to keep everything in order and understand which business is which and really understand their stories is super important. So just to distill it down to I think my recommendation is if you have the opportunity to have a first touch point with a capital provider, schedule a 30-minute meeting. Don't do 45 minutes for an initial, don't do an hour. Just as was discussed in the previous panel, keep it very high level. I personally like having a pitch deck to follow. Also like it very simple and we don't have to follow it completely. It just helps to guide the discussion and generate questions and help us dive deeper. If you have a lot more information, just throw it in the appendix and you can always jump to it. And then don't spend the entire time, know your story, right? That's what was discussed before. So know it inside and out and be able to tell your story and hit all the points that she touched on before. And then don't just speak the entire time. It is very easy when you have a back-to-back meetings to be spoken to constantly, and you have genuine interest in these businesses, and you want to get to the point where you understand in that first discussion, is there or they're there? But if they're constantly just speaking, and I've have this happen a lot, where they'll speak for 15 minutes straight without breaking for questions, and maybe there's not opportunity. I'm tired and don't want to cut off to ask a question, and I lose interest quickly. So I would say know your story, all the points that were made in the previous presentation, but also don't just speak. Make it a conversation. Make sure that there's opportunity to have the other person on the other side of the table ask questions, because that's where their interest lies. And if you can help solve those problems and gain conviction from them, that's where those points are through the questions that they're asking.
Yeah, thanks, Brad. Thank you for catching. I did skip over that, not on purpose. And I'll say to the points. One thing we notice in the room is when it's about founder relationships, we always investigate through movement and action. The words tend to cover the truth of everything. Watch how the person you're working with moves. You want everything to be clear on the table up front. Nothing gets postponed, especially contracts and agreements on day one. Don't push it off. So with that, I would thank you for just getting us kind of warmed up and started here. I know it's this and lunch, and in between there, we're going to ask some questions. So let's open it up to the room. And to the comment earlier, This is a great time to ask what you don't know. You don't have to be smart with the question. This is a great group to ask questions to. I think we got one here in the front. Or it'll come to you.
I'll start here with the microphone, or, okay. So what is your perspective in the VC world for a founder-led and founder-funded exit rather than IPO? I've seen a lot of shift of very popular and well-known brands going from public to private for more controllability of their organization. And if there's more of a shift in that mindset for new businesses, a founder-funded exit, is that something that is interesting to VCs?
You know, and founder-funded exit, I guess I haven't really thought about that much before. I think those companies that you see that are public and then going private are usually more of a private equity play. And people are saying, hey, we can take this business that's performing and make it even more efficient. And so those are usually lower risk, lower return profiles. So something kind of out of scope for us as a VCs, we're looking for like those 10x opportunities. But it has been interesting to see the number of public companies that have been taken private. I think from a standpoint, we love to see exits either as acquisitions or IPOs, because then that delivers funds back to us so we can deliver them back to our LPs.
Yeah, I'd agree with all that as well. I mean, just theoretically speaking, and if I understood your question correct, I'd love to see founder-led exits, just solely based on the fact that if they are a founder, this is likely their baby, right? They're probably the person that cares most about this organization, and so they want to see it through to the end. And that's kind of a notch in the belt, if you will. That's a trophy on the shelf for them to, cross the finish line. So that's kind of the way that I see it.
Sure.
Is this fun?
It is, yes.
Okay. Kirk Ryrie. I founded a company called Idaho Technology that became BioFire, that was bought by bioMérieux. And I'm also, I've got a new company, Faro, one year old. So both old, ancient and startup. My question is this. When we were developing BioFire, Angela, we took your advice and we bootstrapped the whole as far as we could possibly go. We could, in retrospect, have potentially grown a lot faster with the right funding, which we did not have ever. And in retrospect, I think that I made mistakes along the path. But the time to market and the regulatory environment is not a 3 to 5 year thing. It is a 10-year development time to develop that final product that we ended up selling. 10 years with 3 or 4 years of that being regulatory effort alone, 5 years maybe. So my question is, are there different kinds of funds that specialize in different different sort of regulatory environments, different restrictions that way, and or how do you bridge those divides when there's a big regulatory or other kind of temporal hurdle?
I'll speak quickly to the first part of your question there. Assuming that you're speaking, biotech, health tech space, the development time is much longer than the standard time frame that a VC typically looks at, and that's the full expectation of. It just takes a lot of time and a lot of capital to develop products and services within those verticals, right? So, I think this is a space that VCs are starting to get deeper into, and as fund life grows, right, the standard VC fund is generally, contractually a 10-year time frame with opportunity for 1-year extensions, and I think we see over time that funds are extending as we see fewer exits and companies staying private longer. I think with that being said, that VCs are starting to get a little bit more of an appetite to provide capital within those verticals. Epic Ventures and University of Utah Ventures being one of those capital providers. So with our most recent with our most recent fundraise, we actually have partnered with the University of Utah. They are an LP in our fund, and we have broadened the scope, our investment scope, as well as our ecosystem of support, if you will, right? We have a lot of auxiliary and adjacent organizations that provide a lot of insight and knowledge and backing and support within those verticals. And so I think we personally are getting more of an appetite and desire to invest in those spaces, and are starting to do so. So I think as fund life is growing, the distilled way of saying it, as fund lives for VCs are growing, I think that's opening up the possibility for VC dollars to flow into those verticals that have longer development and time to market timeframes.
And just to add to that, there are dedicated biotech and life sciences funds that understand that the regulatory pathway on this is very long, and it may be 5, 7, 8 years until you actually get to a point where the company can actually sell something. And you find a lot of those kind of on the coasts where those type of investors are, and so they're very used to that model. I would say and it's been interesting that we've seen some resilience more in the biotech space as of late than we have in all of ventures, so they kind of really bottomed out a little bit earlier than everybody else, and now we're seeing them come back. But I would say the interesting phenomenon that we see is because you have a smaller amount of biotech and life science investors, if there's a really large raise in your category right before you might end up getting tapped out and not have those investors available in your company. And we saw an interesting phenomenon in the antibody research space last year, where a company raised close, to $1 billion, and then there was some other kind of follow-on antibody technology, adjacent, not necessarily competitive, but really struggled to find investors because they had in a sense, taken an investment those dollars that would have been applicable there. So something to think about. Yes, dedicated investors, but understand kind of who's around you and how they might be accessing that capital.
And one important thing to add on to what they've said is understanding the type of fund that you're talking to. Dustin mentioned they're an evergreen fund. Utah Innovation Fund is also an evergreen fund. So what that means is our fund, okay, traditional venture, they go out, they raise a fund, let's say they raise $100 million, they're gonna deploy that $100 million, and as soon as they've deployed all of that, they're gonna go out, they're gonna raise another fund. And they're responsible to return that $100 million back to their LPs within typically 5 to 7 years. That's what they're promising their LPs. You'll see a return in 5 to 7 years. That timeline doesn't work for most deep tech companies because of what you said. There's so much development time out there. And so you either want to target a fund that is specifically in your industry because they're going to be aware of the timeline that you have. Their LPs are going to be aware of that. Or you want to go after what's called an evergreen fund. The reason the Utah Innovation Fund is an evergreen fund is because we know if we're investing pre-seed in this space, it's going to take longer than 5 to 7 years for us to get a return. The state is okay with that. We can have a longer time horizon. We can get a return in 10 years, in 15 years, and the state will be fine with that as long as your company has been successful. So you need to understand that difference in who you're talking to in venture capital and what their timeline expectation is for a return.
All right, that's great. So we have other questions? And we have one up here too.
Hello. Thank you all. Angela, you were mentioning how it's important to have co-founders that have a balance between maybe the science side and then the business side. So I'm wondering what advice you all have for those of us that are more science-minded that might not be well-versed in the jargon of venture capital and business and economics, and how we can prepare ourselves so that when we have conversations with you all, we understand all the words that you are using and are better prepared to potentially get funding. Thank you.
Yeah, absolutely. There's a lot of resources out there for you to get up to speed, and I would recommend, even if you see yourself as the technical founder or the research founder, you should still learn as much about this world as you can. Because unfortunately, there are a lot of, what's the right word? Shark, maybe? Not great players in these space, so you don't want to get taken advantage of, and you don't want to rely completely on another person or a founder going out and handling this for you. So NVCA is a website, National Venture Capital Association, that you can go to that explains kind of all the venture capital terms. You'll hear the phrase NVCA standard. We're using standard terms from the National Venture Capital Association. So looking into that. There's a great book called Venture Deals. VCs tend to see this as their Bible. It's like what we go off of when we are looking at different terms and we're creating term sheets and things like that. So it's really, really boring, but I would get that book, Venture Deals, and read through it so you understand the terminology and the things we're talking about. And then we know that going out and finding a business co-founder isn't easy, especially when you're usually on universities or campuses all the time. So coming to events like this is great. If you're at the U has an incredible commercialization program that can help you with that process. Our team is in the process, we're fairly young, but our team's in the process of creating a database to match people like you who don't have the business expertise with the right people in industry. And so just know that Utah is aware this is an issue, finding the right co-founder, and there's things in place or in process to help you guys in the future. So stay tuned is what I'd say.
I'll just add to your reading list a book called Secrets of Sand Hill Road. Super, super helpful book that goes in depth and lays out from a VC's perspective, speaking to founders, the whole process, right? We have the opportunity of going through the fundraising process multiple times because we see this constantly, and that's our job. For founders, I mean, most founders, it's their first time, right? So this is your first time going through it. So I think reading the book that Angela mentioned, as well as Secrets of Sand Hill Road, is super helpful in understanding, from the VC's perspective, why the process is structured the way that it is, and then it will help you with all the terminology and kind of the steps in the process and help you optimize your approach to fundraising as you go through that process.
And I would just add, remember your team needs are stage dependent, right? So if you're a Series C or a Series A company, you don't need a lot of business people or a business team to help you. Venture capitalists understand that, and we're really more interested at that stage of, are you an expert in your field? Do you understand this well? And then we can help take advantage of advisors. If there's a small board, people like that can really help you through the business side of things. It's when that you start to move towards growth that's when we'll really focus on, do you actually have some people who are operators in the business? Is it at that point we need to bring on a CFO, something like that? So remember, it's also stage dependent.
I want to add one piece to that because this is something that we talk about in our cohorts where it's mainly postdocs and PhDs. Any PI sitting in the room that's going to stay in their career, what I would advise you to do when you go for the grants, and there is that section for commercializing your work, really use that time and give your postdocs and PhDs the time to actually pursue what it might look like to go into venture, because it takes about 2 to 3 years to start to absorb and understand the vocabulary. It also gives them the runway to prepare for VC opportunities. And if we can capture those things a lot earlier, then after 3 to 5 years, you'll see a constant flow. And the university is already holding space. It just needs to be really dedicated for that.
One more thing on this. I can't believe we haven't said the words AI yet, but AI is insanely helpful.
It is.
So I'll go out there and say it. It's if you're prepping, right, it's just a super useful resource. That's a tongue twister. That you can just have conversations with, right? So bounce questions, whatever's top of mind, bounce questions off of AI, whatever model you're using. Very, very helpful. You could even prep for a pitch and drop in the link and whatever documents to whatever capital provider you're going to be pitching to and say, hey, I'm prepping for a first time pitch with this venture capital firm. Help me distill it, whatever it might be. And it's good for pitch preparation, helping you understand just anything related to the fundraising process.
I second that. We use it as a research tool.
Hello everyone. So thank you very much for all this discussion. So I am Roshan Singh. I'm a founder and CEO of Light Hope Diagnostics. So we detect microRNA in blood sample. I was trained with famous scientist Victor Ambrose, who got Nobel Prize last year for discovering microRNA. My question is, because cancer is global problem, so we also have a subsidiary about to be set up in India. And while I was in India last month, I also met a couple of VC and angel investor. We are still a startup, 1 year old. So my question is that if I accept any fund from Indian VC firms or any angel investor, how is that going to impact future round of fundraising in America? How is the cap table going to look like? And I know this, I have an attorney and I'm going to ask the same question, but I'm throwing this question to you guys. When you see a company which has been funded by some other VC sitting in India, what are your thoughts? What do you think?
I think for us, that's not necessarily of concern. We do have concerns with investors in certain countries, as you might expect. I think China is one that tends to raise a red flag, no pun intended, for us. That just with the relations, the way that they are, and just. For obvious reasons, that's of concern for us, but I don't think, we've looked at businesses that have, Indian-backed investment firms providing capital, and I don't think that's of any concern for us personally. From the investing side of businesses, we do only invest in domestic businesses, but from a capital provider standpoint in existing U.S. domiciled businesses, that's not of concern for us.
Yeah, I'll say it actually is, in my perspective, a good thing, a good flag, a good sign, because it means you're scrappy. You've gone out, you've gone outside of our market, and you've found different resources. So I see alternative forms of funding as really positive signaling. What I will say is it's not necessarily who is funding you before us, it's the terms that you take that is more what matters. So we have gotten deals that are very, very early on in their life cycle that have unknowingly given away most of their company through different safes, not understanding the terms they were signing on to. And if you've already given away 50% of your company and you haven't even gotten out to market, we're not going to invest. That shows that you aren't a smart, savvy founder. So it's not where the funding's coming from, it's the terms you're taking early on that can really kill your chances at funding later on.
So my question is related from an ecosystem perspective. As VCs, do you have patterns or signals, KPIs about is this ecosystem or the startups coming from this specific ecosystem are investment worthy?
What was the ecosystem? Was the ecosystem specific?
Yeah, reframe one more time.
Like, for example, a startup coming from the EU, is it kind of in the recruitment process where the university plays a role on about the credibility of the candidate? Is this thing also valuable in the venture capital industry or not?
Does a university count as part of if they're working here, is that going to build up the likelihood of being invested? Is that what I'm hearing?
Yes, thank you.
From our perspective, having the University of Utah as an LP in our fund, that is a benefit. And honestly, that's part of the strategy of partnering with the University of Utah is there are a lot of, highly intelligent professors, PhD students, and otherwise that are innovating within the university ecosystem. So there's opportunity as a launchpad to be able to fund those businesses and stand up businesses out of the university. So definitely not a detriment coming from the university and definitely opportunity to provide opportunity there.
Yeah, I mean, we're always looking for well-skilled founders who have deep understanding. And so whether that's at a university, at a major corporation, those are all pluses for us. And I think we're coming from a university, if you're in an area where that university is well known, because as we look at different companies, there are definitely different universities that produce founders in different areas, right? And so that can be a plus in that case.
But just to add, yes, typically working with the university is great, but my answer is always going to be it depends, because it does depend on the terms you get, once again, from the university. Just because a university negotiates IP or licensing with you, what I see a lot of times is universities do this different across the country. And some will take as much from you as they can, and then some want you to get out into industry and are much more research and founder friendly. So make sure when you are with the university and you're trying to take your technology research out of that university into industry, that negotiation point is really important to being successful in industry. Because there are a lot of VCs that won't touch technology coming out of universities because they got such bad terms when they negotiated their licensing or their IP in relation with that university. The U, fortunately, does a good job. But our team works with all the universities in Utah because not every university has the same knowledge level when it comes to pulling research out. So just say, yes, it's fine that you're at a university. Just make sure when you negotiate going out of the university that you're getting investor-friendly terms, and our team can help you determine if that's happening.
We have one last question, perhaps less than a minute here.
Yeah.
Sure.
So I wanted to follow up on your point. Of getting to the customer. So in my case, I'm trying to solve a problem in the defense sector. So the problem is similar across all the players. The solution is also similar, but the final product would depend on the specifications of each company. So the product of each company that they have. So and so my question is there like a space where those companies, the potential customers, would invest in my product before it's finalized with a proof of concept? Yeah.
Yeah, absolutely. There's not tons, but there are defense funds out there. And that's why you want to be aware of who you're going after venture funding for and what stage they invest at. And why it's unfortunate that Utah doesn't have a ton of deep tech funds. That's just not the space that our capital ecosystem plays in very well. But there's a lot of defense funds in Washington, D.C. There's a lot of defense funds on the coasts. There was this company I was just working with in Logan that, he's gotten all sorts of great defense investors to invest in his company before they had customers. So I can connect you with him if you'd like. But yeah, there's definitely funding out there. Unfortunately, a lot of it just isn't in Utah. So you're going to have to be scrappier.
I'd also add to that, look at the Defense Innovation Unit. It's a group put together by I think it's under the Department of Defense umbrella. And fortunately, in Utah, we have a representative of DIU, and their whole purpose is tapping into. I mean, it's similar to your question earlier about it's a difficult space for VCs because it's such a long cycle, product development cycle, and requires a lot of capital. So defense is similar in that regard. So their purpose is to try and bring together capital providers, regulators, industry organizations, academia to help accelerate innovative tech within defense and provide capital, right? Provide the resources, capital included, to help scale those businesses and help them, get customers and traction and scale the businesses so that we can benefit, U.S. defense.
Well, let's thank our panel.
Yeah. Thank you, Angela, Dustin, Craig.